I'm Sam Slater from Chelsea, and today I've been joined by Darius McDermott, investment advisor to the VT Chelsea managed fund range. Launched in June 2017, there are 4 funds in the range. There's aggressive growth, balanced growth, cautious growth, and monthly income. And for the second year in a row, this fund range has won the Best Mixed Asset Small Fund Family Group over 3 years in the Refinitiv Lipper Awards United Kingdom 2022. So Darius, maybe we can start with a short introduction to each of the 4 funds.
Yeah, thank you, Sam. They are almost exactly as they say on the tin. The 3 growth funds in order of risk: cautious, balanced, aggressive growth. Primarily, the main source is the weighting to equities and then weightings to other asset classes. So the cautious fund, for instance, will not have more than 60% in equities, but has generally over the near 4.5-5 years been around 40%. The balanced growth will be up to 85% in equities, but never really has been above 60%. And the aggressive growth can be 100% in equities, but has tended to be around 90% with 10% in other assets. The income fund, again, designed it to pay a monthly income. So it pays 11 smooth payments and then 1 payment in the 12th month, which is either more or less, depending on the income left in the fund at the end of the year. So, we have 4 funds with 4 different mandates, and obviously one with an income mandate, which has delivered on our objectives.
And what's been key to the success of the range?
I think there are a number of factors that have contributed to the consistent performance of the fund range. Firstly, the team of investment advisors. I've worked with Juliet a long number of years, and James and Ryan for the best part of a decade. And the team has complementary skills and complementary experiences. And actually, across the team, there are quite different investment styles. And that has come together very well as a team to help deliver these strong returns that have seen the funds win these awards. Secondly, fund selection in aggregate has been good. Of course, the fund has picked the odd bad one, but across most geographies, most asset classes, fund selection has been a real additive to the fund's performance. And then lastly, I think an area that the team didn't have great experience in previously was the raft of alternative investments that one can get on the London Stock Exchange in investment trust structures. The funds started with a very small investment in sort of a solar and an infrastructure trust, and that's now broadened out across many different multi-assets over time. And the funds have actually benefited very, very well from some of those alternative assets, which the team hadn't got that long-term track record or long-term history in. So that's been a real added bonus towards funds performance.
And is there anything that hasn't gone to plan?
Well, it wouldn't be an ideal world if everything went well for us. Of course, that's not the case. Asset allocation is one skill, and bits of that have worked. I suppose the one obvious standout that hasn't worked has been a structural underweight to US equities. Being a UK advisor to the funds and the funds being sold and distributed to UK buyers, you would always tend to have had a greater allocation to home markets. Whilst the funds haven't been hugely overweight the UK, they have been overweight other areas like Asia and Europe and Japan. And that's led to a structural underweight in the US, which, with hindsight, hasn't been the world's greatest investment call. Also, we have had a tilt throughout the lives of the funds to growth styles of investment over value, particularly highlighted post the pandemic in 2020, when the growth funds absolutely did very well and the value funds did very badly. The smaller weighting to the value funds didn't do well. But since the vaccine announcement in sort of November, December 2020, the value styles in short bursts have really outperformed. What's more, actually, the growth style funds have underperformed. Some of the really high growth funds, which have done well for us over time, have had a difficult 6 months. So we try to advise the funds to have a balanced set of positions. So it's not all in on any one strategy or any one style. But the tilt that the funds have had to growth have certainly not helped the aggressive fund over the last 6 months.
And it's obviously been a bit of a difficult period for income investors. How's monthly income stood up in terms of the income that it's generated?
Yeah, I have to say that's one area that I think as advisors to the fund, the team have been rightly proud. As we know, post-COVID pandemic outbreak, fast sways of equity world had to cut their dividends, some for regulatory reasons. They were forced to by governments. Certainly anybody who took government money had to cut all their dividends. And they were just areas of society, obvious things like travel and leisure, that just stopped to function. So they were unable to pay dividends. But we know that the majority of the people who buy the income fund actually take an income from that fund rather than have that reinvested. And we know that a large chunk of the client base rely on that income. So we made it a great focus on the fund actually not to cut the dividend, unlike a lot of the dividend funds that we helped cut their dividends. The team advised actually, that they focused on maintaining that dividend. And if you had invested 10,000 at the beginning, you would have actually received more than 2,000 of income in the lifetime of the funds. So we didn't cut the dividend at all on the funds, or certainly on the monthly payments that we made. And we are proud of the fact that we were able to keep that dividend at least as where it was, and actually slightly growing over the last couple of years.
And how are the funds positioned today?
And the funds have got a good balance, I think, at the moment. We've got a bit of... The funds are currently running a small to moderate cash weighting. The funds have been gently selling assets that will suffer in an inflationary environment, trying to look for assets that will benefit an inflationary environment. So the funds have certainly sold bits of their fixed income allocation and been buying some alternates on the in the investment trust world that may benefit from inflation. So assets where maybe they collect rent, but those rents have inflation uplifts, things like that. There's been some subtle thing, but diversification and balance definitely the key words, and a bit of caution. And
the aggressive growth fund still has quite a heavy weight towards growth, is that right?
It is correct. It is correct. It's not as growthy as it once was, but the funds still continue to see value in large cap technology areas. The fund has been topping up one of its technology investment trust positions that the fund is able to buy at a discount. So, and the team still are strong believers that some of these large cap technology names that are wholly ingrained in all of our lives aren't going anywhere. They may have had a bit of a sell-off and a bit of reversal. So the fund has been adding selectively around the edges in some of those technology areas. Some of the other holdings in the fund have had a difficult period, and the fund has reassessed whether to continue to hold them, add to them, or potentially sell. So, yeah, the fund still definitely does have a growthy tilt, and whilst it's got a bit more balanced over time, we would expect it to stay that way.
And what about the other funds in terms of maybe the equity weight? Has that gone up lately, or has it gone down?
The equity weight has actually gently been going down, but that's been as a function of the increase in the alternate assets. When the funds were launched in June 2017, there were some alternative assets that we could look at, but actually the actual London listed market in these areas has grown hugely in the years that we've been advising the funds. So the opportunity set has broadened into generic asset classes like music royalties and shipping and warehouses and digital infrastructure, things that just weren't even on the London listed stock exchange 4 and 5 years ago. So the equity weighting has creeped down in some of the other funds, but those other assets in investment trust structures are still equity like, because they trade on the London Stock Exchange every day, even if the underlying assets are not equity. They may be solar assets or wind assets or music royalty assets. So we need to be aware when we advise the funds to try and keep some balance and not to take too much risk.
And if you'd like to find out more about the VT Chelsea Managed Fund range, please go to chelseafs.co.uk.